Welcome one, welcome all to DeFi Crypto and Airdrop / DeFi University. For our DeFi High daily 9 a.m. Pacific, noon Eastern time, where we teach entry-level DeFi. So I want to I wanted to jump in here because I want to share something. I feel this is really important before we dive too deep. And I want to get your take on this, David.
Absolutely.
So I'm seeing on Twitter, those that don't know, this is the BlackRock CEO, Larry Fink, and everyone is posting this. It's a clip, and I'm gonna play it real quick. Let me know if you can hear this.
Are probably processed and more.
I can.
I think the movement towards tokenization, decimalization is necessary. It's ironic that we see two emerging countries leading the world in the tokenization and digitization of their currency, Brazil and India. I think we need to move very rapidly. Doing that, we would be reducing fees. We would do more democratization by reducing more fees if we had all investments on a tokenized platform that you can move from a tokenized money market fund to equities and bonds and back and forth. One common blockchain, we could reduce corruption. So I would argue that yes, we have more dependencies on maybe one blockchain, which we could all talk about. But that being said, the activities are probably processed and more secure than ever. I think the movement towards tokenization.
So basically what he's talking about is, he feels there's a need for, all these tokenized assets, the value, everything to be moved on one blockchain. And everyone instantly went to ETH. And if you look at a lot of the things that BlackRock's doing, then of course with their Biddle fund and things like that, that is exactly, do it, watch what they do, not what they say. In this case, you would be correct. But I think it's more nuanced than that. So I did some digging this morning and went over to rwa.xyz to, that's where I do most of my data sourcing. And you can, it tells you all about tokenized assets and RWAs. Now you need to understand something. Now, if you look at this, you have distributed and represented. In a nutshell, distributed means that it's retail facing, basically, where I can send, tokenized Tesla stock to David. He can hold it in his wallet. It's something that he can custody. So that is distributed. And Ethereum leads the way, 60%. They have 60% of the market share, 100%. However, represented, Canton owns 95%. And what represented is that is B2B, or institution to institution, business to business. So that is the chain that institutions so far, it can always change, but so far it is the chain that is being used by institutions to record value and to record ownership and be able to move that and increase the liquidity. So it's important to understand the use case because, again, yes, Ethereum, as far as retail DeFi, David talks about this quite a bit. David is a huge ETH bull because that is where the liquidity is. That's where the volume is. That's how we earn in DeFi. But you need to understand that these institutions are building out their own chain to communicate with each other and to record value amongst themselves. So there's, it's important to understand these nuances of the technology. What's your thoughts on that, David?
Yeah, Mike, I just want to make sure that my audio sounds okay. I hope that it does. So here's the thing. TradFi is so much bigger than crypto and DeFi. So much bigger.
Yes.
I think what's happening is Canton Network. We're going to start to see JP Morgan move some of their repo book onto Canton.
Yep.
And that is much, much, much bigger just by itself than all of crypto and DeFi. So, we're seeing the beginning, just the very beginning of these RWA plays on chain. And, I think the institutional stuff is beginning with Canton. And it wouldn't surprise me if Canton ends up being the chain, the chain, Canton plus Connexus. That ends up being like the institutional side. And then we got the public DeFi side with Ethereum and the handful of other smart contract platforms. So, yeah, man, I think Look, I was trading RWAs this morning, and that's the future. Because
No,
if I can,
oh, sorry, go ahead.
well, if I can gain exposure to, gold and silver and copper, and I can trade the yen and the Swiss franc, and I can trade euros, like I can do all this stuff out of my DeFi wallet. Like,
Well,
why would
and
I?
not just trade, because you were talking yesterday with Jake on on our Wednesday show, for advanced DeFi strategies.
Mhm.
You were talking about using these synthetic commodities and things like that to do advanced DeFi strategies. So
And that's
basically
exactly what I
buying,
did today.
yeah,
Mhm.
buying tokenized gold, taking that, being able to lend that out, or go over to Pendle. I mean, there's just so many things that you can do with it. Once, what are we doing here? All right.
Oh,
you know,
the
yeah.
thing. Yeah.
Once something is tokenized, it's much more liquid. There's much more that you can do with it. I have silver sitting in my safe. It's great if, the world goes to shit. I need to, hand it to you because I need some eggs or something. But if I want to use it online, to do DeFi or do anything else like that,
Really tough. Really
good luck.
tough.
Yeah, good
Yeah.
luck.
Yeah. You'd
So,
have to give up custody, right? You'd have to
yes.
store it in a vault with a trusted third party, and then maybe
Mhm.
you'd be able to borrow some percentage against it, some LTV against it. But you got to trust that third party. Here in DeFi, if I've got tokenized gold or tokenized silver, well, maybe not tokenized silver. I haven't seen it for tokenized silver yet, but
Mm.
I've seen it for gold, like on Aave. If I've got XAUT, that's Tether Gold. I can
Yeah.
supply that as collateral over an Aave. I can easily borrow against it. Piece of cake. So I think it's really just a matter of time until you can supply treasuries and borrow cash overnight against treasuries. So that's the repo. That's the repo market. And
And that's huge.
it is.
And,
And so for me, what
and
I'm most excited for.
can you explain, since this is the entry level, could you explain, just kind of simplify what a repo is?
Yeah, so it's simply, usually an overnight lend borrow where you put up a piece of collateral. Almost always it's US Treasury assets, and then you're able to borrow dollars against it.
Mm,
Usually they call this like at a window. So
mm.
they'll say, like, institutional traders will say, hey, we're going to go to the Fed window and borrow at the Fed window.
Yeah.
Well, you have to post some type of collateral. That
Mm.
collateral is a US Treasury bond or a US Treasury note or a US Treasury bill, and then you're able to borrow dollars, usually overnight, and also usually at near the Fed funds rate. So either at the upper bound of the Fed funds rate or the lower bound of the Fed funds rate. So you
So basically,
post
a
your
short-term
dollar
loan
and you
for
borrow.
institutions and banks and things like that.
Exactly. And so that's what broke, or part of what broke in 2008. So when banks can't borrow or they don't trust one another to borrow against each other, then that's when everything froze. So, yeah. But I think what you're showing here with Tether Gold,
Mhm.
um, I mean, look, the beauty of this is that it's trustless. You don't have to, trust a third party custodian. So let's say that you've got physical gold, right? And you want to be able to borrow against that physical gold. You're going to have to take that and put it in a vault somewhere. But if you just want to be able to get exposure to gold, you can use XAUT, and then the process of borrowing against it is a piece of cake. You can take it on over to Aave, and you can borrow whatever the LTV is. You can borrow against it, and you can have cash, or you could borrow any type of asset on Aave against it. Actually, you know what? I'm not quite sure about that. What they allow you to borrow. Some of these markets on Aave are isolated, so you won't be able to borrow, let's say, ETH against your gold. But that could be an interesting trade, or maybe borrowing Bitcoin against gold, because if you supply the XAUT as collateral, you're long gold. If you then borrow cash, you're short cash, which, since it's pegged to one, is usually no big deal. You just have to worry about the borrow APY. But yeah,
So,
there's the market. Mhm.
so it looks like they might be adding it here soon. You got Tether Gold, um, but it looks like there's no supply APY yet, no total borrowed, anything like that. So it looks like they might be adding it soon. You know better than I would What's
Yeah, so here, if you scroll up to the top, I'm curious to see what chain you're on there. Okay, so that's the core instance, that's the mainnet.
okay?
So I'm almost positive if you click there, Mike, on details, I'm pretty sure that you can actually supply. You see where it says for Tether Gold, XAUT, it says isolated.
Oh, gotcha. Down
Yeah,
here.
if you click on details, let's just see. Okay, so it looks like supply info. Yeah, it looks to me like you can supply to this market. Now, you're not going to earn anything,
Hmm.
but yeah, you can. It looks like you can supply here. And then I'm not quite sure what you can borrow against it, though. You can probably only borrow stables against it for right now. Um, but let's see. What does it say? On Ava here, I'll just bring it up real quick. In fact,
Yeah. Well, let's share your screen. You know how to navigate around this stuff.
yeah. So here, let me go ahead and do that, and let's take a look at this. Here, give me 1 second. I want to turn off my VPN,
Okay.
and here, let's hop
There
on
we go.
over here. There we go. Awesome. So back in Aave. Now, what I want to look for is XAUT. There's that Tether Gold. And okay, so I see the market. I want to go ahead and click through. And what I'm looking for here is what I can borrow against this. Now, I'm not sure. It says, okay, asset can only be used in isolation mode. You cannot supply other assets as collateral for borrowing. Assets used as collateral in isolation mode can be borrowed to a specific debt ceiling. So let's see here. What can you borrow against this? I'm pretty sure you can borrow stables against this, but not 100% positive. So, you know what I'm going to do? I'm going to go ahead and connect one of my burner wallets to this, just so that I can play around with it without having to, worry about exposing any important information. I can just run through this real quick. Okay, so over here, view token contracts, add to wallet. There's the Oracle price. So it looks like if the utilization rate is 0, then Aave may not allow borrowing against XAUT. You,
And that could change.
yeah, that could definitely change. Let's see if that is, if you can supply that on any other chain. I'm just curious here. So the Prime instance, okay, got it. How about Plasma? That's for stables. Yeah, it looks like you can supply XAUT on Plasma, but I'm not quite sure if you can borrow. I don't know if you can borrow anything against this here.
Does the liquidity have to reach a certain point maybe before there's the liquidity is there for them to feel comfortable borrowing and lending all that?
I don't think so. I
Okay.
think I
Okay.
actually do think that you can borrow stables against XAUT on Aave, but I'm not able to see it there. So all I'm doing now is hopping on over to Euler, and I also want to take a look at Morpho. So these are three of the largest and most reputable money markets in DeFi. So if I just go ahead and open these three up back to back, we've got Aave here, and I'm going to bring up the main instance. So here's Aave, and then we've got Euler, and on Euler, I'm on mainnet here, and the asset that I'm looking for is XAUT. There we go, XAUT. Okay, any market. And so okay, so this is the Euler Prime market, the largest market, and you can see the supply amount. And if I go ahead and click through to this market here, it's going to say, yes, can be used as collateral by 6 vaults. Awesome. So what can I borrow against it? It says can be used as collateral. So I can borrow any of these assets. These are all stables. So I
Mhm.
can borrow any of these stables against that XAUT. And, actually it says here, I can only borrow these three, it looks like. If it's telling me that the max LTV is 0% for these
Yeah.
three stables, then I probably can't borrow them.
And
But if the,
those that don't know what LTV is it's loan to value. So basically, if like say it's an 80% loan to value and you have $100,000, it will allow you to borrow up to $80,000, 80% of 100,000. So sorry, just go ahead.
Oh, yeah. So, the LTV is super important to understand. So if I supply $1,000 of XAUT and my max LTV is 73%, then that means I can borrow up to $730 against that $1,000 of XAUT. Now, remember, the unit of account on all of these money markets is the US dollar. So if I can borrow 73% against my $1,000 of XAUT, and I do that, let's say that I borrow that $730. Well, what happens if XAUT tether gold goes up? What happens if it goes up, if it appreciates? I'm looking over here at, just gold futures. And to me, it really looks like we're just going to push up towards 5,000. So if we're going to push up towards 5,000, well, let's say that you supply XAUT as collateral, you supply $1,000 of it, you borrow $730 against it, and XAUT goes up to 5K. Well, now all of a sudden you have a little bit more borrow capacity. But let's say the opposite happens. You supply that $1,000 of XAUT, you borrow $730 against it, and then XAUT moves lower by a couple of percentage points.
Yeah.
Well, all of a sudden you're going to get very, very close to you see the LLTV? That's your liquidation LTV. So if you borrow $730 against your $1,000 of XAUT, and then all of a sudden that XAUT is down by, what would that be? 2 percentage points, $20. So if it's down by 2 points, well, then all of a sudden you're going to get liquidated. The Euler here is going to have to sell some of your XAUT in order to repay some of that borrow so that you can get back below the liquidation LTV. And if XAUT really moves lower, you could suffer a significant liquidation. So you got to be careful.
So Euler does partial liquidations, not just full liquidations.
I believe so. I believe most of these money markets do that. Yeah.
Nice. Well, I mean, that can be a positive thing because potentially, it will keep you from losing your whole nut. Like if you're not paying attention, you're out living life, and all of a sudden gold takes a dump and you don't notice it, and you're not positioned properly, then the health of your borrow, your loan, and borrow could be such to where the whole thing gets liquidated. You of course, whatever you borrowed, the $730, you get to keep that, but the $1,000 that you used as collateral is now gone, potentially.
Right. Yeah. So if you're getting partially liquidated on the way down, and then the asset rebounds, well, then you won't go to zero on the position. So it really depends on the protocol in the market that you supply XAUT to. And so that's why I brought up Morpho, because notice this. You see in this market on Morpho, this is on mainnet, on ETH mainnet, you can supply XAUT, you can borrow Tether against it, but your liquidation loan to value is 2 points higher than it is over here on Euler.
Nice.
So that simply means that you've got a little bit more room over here on Morpho. But
a little more cushion for the pushing.
Exactly. And so, but another thing you got to think about is the rate at which you're borrowing those stables. How much are you paying to borrow those stables? Because
if you're not regularly paying that down, then your loan to value is starting to get more and more unhealthy. So these are all factors and things you need to understand about DeFi and about these borrow and lending markets. Sorry, go ahead.
It really is. And so if I'm going to borrow USDT Tether against my XAUT, my Tether gold, right?
Yeah.
If I want to borrow stables against my Tether gold, well, not only do I have to find out where I can borrow the most, where the LTV is greatest and where the LTV is highest, but I also need to check in on how much I'm going to pay to borrow. So if I'm over here on Euler and I'm looking to borrow USDT against my XAUT, well, I can borrow at 5.28% APY.
Gotcha.
Now, if I hop on over here to Morpho, all of a sudden, this is the same pair, You know, very similar markets, same chain, different money market though.
David's shopping. David's shopping right now for the
I'm
best rate.
shopping for loans. You know,
Right.
that's basically what I'm doing.
Yeah,
I'm shopping for loans. You know, I'm shopping for the best rate. So
exactly.
if I hop on over here to Morpho and I see, oh, you know what? I've got a higher LLTV and I'm going to pay only 3.02% to borrow USDT.
Yeah,
Well, that starts to
much
look pretty
better rate.
interesting.
Now,
Yeah.
now, now let's look at on each of them, just so people have a full understanding. How much are you earning on XAUT on each platform for lending it and providing it as collateral?
Probably next to nothing. Probably just about nothing, I would
I
say.
just want people to understand, the full scope of how this works. So,
Yeah,
you're
so
okay. Yeah,
see, yeah,
0.
right here on Euler,
Okay.
0. If I
And what's
hop on
on
over here to Aave, 0. If I
okay.
hop on over here to Morpho, let's see, collateral, XAUT, there's my LLTV, there's utilization, LTV, LLTV. So rate, that's the borrow rate.
Can
Let's
you
see
click on
here.
the asset itself or go to lend or
Yeah, I'm gonna go back. And so collateral. So I think if I hit, instead of borrow, if I hit
yeah,
earn. So
yeah.
if I go to earn and I type in XAUT, yeah, I don't think that you can earn anything.
Okay. So
Supply,
no,
yeah.
sometimes, on most assets you can, get earn yield off of lending it, and then you can take out a loan, and there's a separate interest rate for the loan, and depending on the two numbers, then either you're actually, like, say you're earning 10%. I'm just going to throw out some numbers. You're earning 10% for providing liquidity, and then you take out a loan that is costing you 5%, then potentially that's a net positive of 5%. So, these are all the little things that, calculations that you need to do to make sure that the DeFi position that you're getting into is profitable. You want to make sure that you're not just simply throwing liquidity and, lending it to where, in this case, you're not earning anything. And then you're taking out a loan against it where there might be a huge, interest rate, and not understanding that as time goes on, if you're not paying that down and the asset is moving, the collateral asset is moving, potentially it puts you at risk at liquidation, either partial or full. So these are the nuances that you need to understand about about DeFi and borrowing and lending. So sorry, go ahead. I just
No, no, no. So as you were speaking, I was just thinking what you're describing is referred to as interest rate arbitrage.
okay.
Where, and so I wanted to bring up, a potential interesting interest rate arbitrage play, not using stables. So it's really, really easy to cook up these interest rate arbs using stable coins and yield bearing stable coins. But an interesting one here is, potentially using wrapped EtherFi. So this is EETH. So wrapped EtherFi ETH. So
Okay.
this is a yield bearing version of ETH. And you see where it says,
Real quick,
Mhm.
explain the yield bearing aspect of it.
Yeah, so this is an LRT. This is a liquid restaking token. And so you've got your ETH, your spot ETH. You've got your wrapped ETH, which is simply an ERC20 version of ETH that you can use in DeFi. You've got your wrapped, so you've got your LSTs. So those are liquid staking tokens used to, secure the network. And then you've got your liquid staking tokens, which is like another layer on top of the LSTs. And those liquid restaking tokens, it's basically eigenlayer that pioneered that. And they use these LRTs, these liquid restaking tokens, to secure multiple protocols. So you use the same ETH to secure many, many, many different protocols.
Hmm.
And so that makes that version of ETH yield bearing. And a lot of the points programs are what generate the yield. So for wrapped EtherFi ETH, if I take a look at you see where it says this supply APY 0%, but then it says 3x EtherFi. I'm assuming that means 3x EtherFi points. Yeah. So EtherFi loyalty points, but it's not showing me any yield on this. And that's actually misleading. And so the reason why this is misleading is wrapped EtherFi ETH has an intrinsic yield, but for some reason
How is that collected? I've always been
it accrues. Yeah, it accrues to the token. So let me hop on over here to CoinMarketCap.
I'm sorry, I don't mean to get you down a rabbit hole. It's just this is something I've always been curious about. Is people talk about these yield-bearing tokens, and I'm always curious: do I need to go to a website to collect that yield? Does it just show up in my wallet? How does that work?
Yeah, so it accrues to the token price. So notice, you see how wrapped EtherFi ETH is trading for 31.86. But if I hop on over here to just TradingView, ETH, just spot ETH, is trading for 29.40. So it trades, these LRTs trade at a premium. They trade at a premium to the spot.
It's super simple. It just basically reflects in the price of the token itself, so that when you go to sell it, then that profit is built in.
Yeah. So it just it accrues to the token price. And
Perfect.
So the thing that's most interesting to me about that interest rate arbitrage play that you were just describing is, let me hop on over here to EtherFi. And what I'm looking for is, I want to find out what is wrapped EtherFi ETH. What is the yield on wrapped EtherFi ETH right now? And so that's what I'm looking for here on their website. I'm looking for the intrinsic yield of wrapped EtherFi ETH. And if maybe I might need to use just Gemini to find that yield real quick. Let me just ask, what is the intrinsic yield of wrapped EtherFi ETH? And let's just see.
We're calling David Hammerhands with it.
Yeah, you can hear. Oh man, yeah, you can hear that. Yeah, because I think here. Let me just change my microphone to.
Oh, you're fine. I'm just clowning.
Oh yeah, no, it must be really annoying for people though. So check this out. So the yield is usually around 3%. So let's just say that the yield is 3% for this LRT. And for most of these Ethereum LRTs, and there are many of them, the yield is usually around 3%. So that's what you get for staking your ETH and then allowing it to be restaked so that you can secure the network and secure a bunch of other protocols at the same time. But you also get points. So now, if we know what the yield is on our collateral, and we know that the collateral is intrinsically yield bearing, then we can start to construct an arbitrage play on the interest rates. So over here on Aave, you see where it says supply APY 0? Well, 0.01, but basically 0. We now know that the real supply APY is actually closer to 3%, plus the points multiplier. So you get these points, you'll get an airdrop at some point of ETHFi, the token. So that's actually pretty valuable. So now if we know, okay, well, if we supply wrapped EtherFi ETH as collateral on Aave, we're earning 3% on our collateral. We could then borrow ETH against it at 2%. If we borrow at 2%, but we're earning 3% on the collateral, then you've got it's net positive. You got that 1 point, that nice little 1 point spread there, but you're also earning the points and you're long ETH. The reason why you will always be long ETH if you supply wrapped EtherFi ETH and borrow ETH against it is because there has to be a little bit of a difference between the US dollar value of your collateral and the US dollar value of your borrow. So you're always going to be a little bit long ETH. So that's actually a pretty interesting play. Now, what are the risks of something like this? Well, if wrapped EtherFi ETH, remember that's your collateral. Yep. If wrapped EtherFi ETH depegs and you borrow too much against it, that depeg event could get you liquidated. So you got to be careful about borrowing too much.
On October 10th, there was that stablecoin that
USDE.
Yeah.
So that looked to me like a targeted attack on Binance's margining system. Mm-hmm. That's what that looked like to me. But yeah, I mean, these interest rate arb plays are really, really interesting. it starts to get good when you take a look at the stable coins, though. So if we just hop on over here to the flight simulator that I built, these products may be something on Pendle. And I saw that Pendle, they made an update to their tokenomics. I think that was
Yes, it was
yeah,
like today or yesterday.
yeah. I think it could have been today, but yeah, I was just reading a little bit about it today. And so if I hop on over here to Pendle, this is one of my favorite protocols. It is by far my favorite for fixed income in DeFi. And so you see up top here, this stablecoin top fixed APYs. So if I wanted to build a stablecoin portfolio, and I do, and in fact, today is Thursday. So in DeFi U, we're the call today. One of the calls in one of the paid calls is DeFi Alpha and Opportunities. And so today I'm going to be going through how to create a fixed income portfolio. And I'm going to walk through a couple of PTs. Now, and I know that this is supposed to be a beginner call.
Well, the anybody that's interested in those calls, David's DeFi University is all free. His course, from beginner to advanced, all the course material. The calls that he does daily, though, are about $97 to $100 a month. But there's 2 calls a day, and I would suggest that you go through his course first, because those calls can be kind of high level, when it comes to, what they're talking about. So to make it, make sure that you get the full value from it, you definitely want to get up to speed with, the terminology and, kind of what they're talking about. Otherwise, it's like, if you don't speak Spanish and you tuned into a DeFi show, that's basically what it's going to feel like. I'm just being honest.
Yeah, no, that's exactly what it is. It's a different language. It's a
Yes.
language that you have to learn. So, for me, if I'm looking to earn between 10 and 20% APY on cash, the place that I would go to do that is Pendle. And if you just think about that for a second, 15% on cash on average, dude,
It's huge.
that's like S&P returns, okay? But on cash.
Yeah.
And a lot of that you can do fixed. So, just being able to do 15%, weighted average fixed.
I'm just
on
waiting for any
cash.
kind of alt season where I can, make a decent chunk of change so I can just put it in stables and do what you're talking about here.
Well, yeah. So today I'm going to deploy some capital into these strategies live. So this is really great stuff. And, Pendle to me is, it's the best. It's basically a bond market is basically what it is. It's
Such
a
a cool
DeFi.
platform.
It's so cool. It's so cool. It's a DeFi bond market.
Yeah.
So yeah. So Mike, what did you want to continue to discuss here? Because I know this is supposed to be a beginner call, a little bit more of a beginner call. And so I kind of wanted
Yeah.
to go
Jump
through.
into that.
Yeah, I kind of wanted to go through some.
You're the professor.
So, kind of what I wanted to talk about today
I'm the
was,
translator. Whenever you get
yeah,
too spicy or too technical, then I that's when I jump in and try to decipher.
yeah. Well, I wanted to go through this stuff, really, really basic stuff in the beginner DeFi concepts course. Oh, and by the way, Mike, I am almost done with DeFi High School with all of that content. So we'll be able to hopefully start going through that starting
And that's all
on
going to be
Monday.
free content as well, correct?
It's all free. Yeah, it's all free.
I want to make sure that people understand this, because we're not talking about this stuff because we want you to go and pay for a subscription or anything like that. David spent a lot of time to build this stuff. Me and Jeff, we do this show basically for free. We genuinely want all of you out there to learn how to do this to change your financial future. We know that a lot of you out there are struggling financially. DeFi is a way that you can put what liquidity you have to work, but you need to, just like with any investment, you need to mitigate your risk and you need to do it right. You need to do it with an educated mind on how to navigate these markets. Otherwise, you're the exit liquidity for somebody else. So please before you deploy any liquidity into DeFi, I don't care if it's staking, I don't care if it's lending, I don't care what it is. Educate yourself on how these platforms work. understand the risks, understand how to to mitigate the risk that you're taking to ensure that you're profitable. Because it doesn't matter how much money you throw at this. It doesn't matter what the APR is. If you put it on a platform that doesn't have basic security, or you get rugged, or it gets hacked, or you need to understand how this works, or you connect your wallet. Like David was talking about this yesterday. You connect your wallet and it's malicious, and they just drain your wallet of all your NFTs, which is your a lot of your DeFi positions, like arrow locks, things like that, your liquidity, your Bitcoin, your Ethereum, all of that. So please go through these courses. The links are in the description below. Go through these courses, learn about this stuff, jump in our community in the Discord. We're happy to to explain anything that you have questions about. David has a great community. That $97 a month, you can be on 2-hour-long live calls a day. It's the only part of what he the only thing he charges for, and it's invaluable. It's there's people in the chat right now, Big Lou, DeFi Don, Paulo, they're all community members with David. And they're in the chat right now talking about how valuable it is. And so I know that they've been there for a while, and they're much smarter than me on this advanced DeFi. But I'm sorry, go ahead. I just wanted to make sure that people understand that all of this is free.
Yeah, it is. And look, I'm a trader, so I make money from trading. But in the community here, all of this information, if you go to the classroom, all of the DeFi protocol deep dives, maybe you want to learn more about how to use Pendle. Well, guess what? All of the information, learning how to use Pendle, it's all free. And I compiled it all together for everyone right here for free. So, if you want to learn about DeFi, learn about crypto, learn about these protocols, go through these courses, build your skill set from beginner DeFi concepts to investor mindset stuff. Honestly, the mindset stuff is probably 80% of the game. Learning about liquidity provision and how to use money markets, like we were talking about earlier during today's call. And then eventually you'll get to perpetual futures trading. Now, Mike, I turned all of these courses into books, and the books are actually, the formatting of the books is better than the online courses. And having something, that you can physically hold as you're going through this course material is really, really valuable. And I can't wait to get my hands on the books. Like I'm waiting for Amazon to deliver them to me. I haven't even gotten hands on with them yet, man. I published them literally a month ago. You want to know the funny thing about the books on Amazon is that people have been buying them. I didn't expect them really to sell, but they have been selling, which has been amazing. And so, but the weird thing about it is, you know what book people are buying the most of? The perpetual futures book. And then the one that they're buying after that is the concentrated liquidity provision book. You know which one they haven't bought yet? The most important one, the investor mindset book. So, if I go on over here to the course hub, there's a reason why these courses are in order, because you start with the beginner DeFi concept stuff.
It's foundational.
You have to. And then you move on over to the mindset stuff. And only after you get through the beginner and mindset stuff do you then move on to liquidity provision and money markets. And the perpetual future stuff is the last. It's last for a reason. Because if you start there, you will end up paying the market much more tuition than you're probably comfortable paying.
Yeah.
So, yeah, man, it's really funny to see that. But let's go ahead and hop into this history of trust, because what I found to be so valuable is just learning about money, because all of these DeFi protocols, they're basically incentive structures. All of the tokenomics schemes, it's just about incentives. And so if you want to learn about incentives, I think the best way to do that is to just go back in time a little bit and learn about how humans have created different types of money over time. And that will really help you to understand Bitcoin and Ethereum and the US Treasury-based system. So this is really, really valuable content, for advanced users too. So why don't we go ahead and play through this? I want to see if, let me know, Mike, if the audio works here.
All right.
All right, welcome to the Explainer. Today, we're going to take a journey through thousands of years of history, all to understand the future of money. We're going to see how giant stones, simple wooden sticks, and some very clever Italian bankers paved the way for the digital finance we're seeing today. So, let's dive right in. First things first, let's just challenge a core assumption most of us have. We tend to think of money as, coins, paper bills, something physical you can hold. But what if that's not quite right? What if money has always been something much more abstract? Just a shared story, a collective agreement about who owns what. And this right here is the key idea for our entire explainer. Money isn't the gold or the piece of paper itself. It's the system that keeps track of everything. You can think of it as a technology for social memory, a ledger that remembers who owes what to whom. So really, the history of finance is just the story of this ledger technology evolving over time.
That's so cool. So there are different types of ledgers, whether you're using a stick that you break in half so that, the stick only fits back together in a certain way, and then you take out little notches within that stick, or maybe you're using shells, or maybe you're using like one big shell, and that's kind of like the collateral or something. And then you can have little shells that you can like borrow against it. Or maybe you're using, gold coins or silver coins, and then you're writing down on a piece of paper, keeping that ledger written like that. Many, many different ways of creating these ledgers. Or maybe you're using Bitcoin, a shared distributed ledger. It's the same idea, same concept.
Okay, so let's start at the very beginning. We're going to look at these ancient ledgers of trust, which, as you'll see, were some of the first truly decentralized systems. So get this. Way out in Micronesia, the people on the island of Yap used these massive limestone discs called Rai as their money. And when I say massive, I mean some of them were 12 feet tall and weighed 4 tons. Their size alone forced a brilliant idea. They had to completely separate the concept of owning something from physically possessing it.
So how on earth do you spend something like that? Well, you don't. You can't just hand it over. Instead, a transaction was a public announcement. The owner would just declare that the stone now belonged to someone else, and the whole community, the elders, would witness it. The ledger wasn't written in a book. It was distributed across the collective memory of the entire village. It was literally a distributed database where the servers were human brains.
That's so cool. So just think about that.
Basically, all the elders were like nodes.
I know, right? You got your distributed ledger, but it's the human brain, and everyone just has to witness the transaction, man.
Yeah.
That is so cool.
And if you think that's wild, this next part really shows just how abstract their system was. There's this famous story about a really valuable Rai stone that sank to the bottom of the ocean in a storm. The crew that was transporting it survived, and they could all testify to its size and its value. So the community just agreed. They agreed the stone was still there at the bottom of the sea, and its owner could still spend it. Its value was based purely on social consensus, not on anyone being able to see or touch it.
Okay, so the Yapi system was built entirely on social memory. But halfway across the world, in medieval Europe, a completely different system popped up. This one didn't rely on memory at all. It relied on a really unique kind of physical proof.
They used something called a tally stick. Here's how it worked. They'd take a stick, notch it to show how much a debt was for, and then split it right down the middle, lengthwise. The lender got one half, the debtor got the other. The security here was pure genius. The unique random grain of the wood meant that only those two original halves would ever fit perfectly back together. It was impossible to forge. It was basically a cryptographic key, but made out of wood.
Can you imagine lending gold to someone and your receipt
Based on a notch stick?
Instead of like, you've got your tokenized gold, and you lend it and you receive like a receipt token in your wallet. Instead of that,
if you think about it, the way that the dollar is, where it's not really backed by anything, it's kind of the same thing. You have this thing that everybody trusts it's worth something, and you're exchanging it for something that actually has value.
I think that this is whether it's on a digital ledger, or it's on a stick, or it's on a stone, or it's distributed in the minds of the community members, it's all the same idea, right?
Yeah. It's just
But the way this system ended, wow.
So I think God loves the most ironic outcome.
Yeah.
This is ironic.
The
It's a
burning
story
of
in
it.
itself. In 1834, the British government decided it was time to get rid of centuries' worth of old tally sticks. So they started burning them in the furnaces under the Houses of Parliament. The fire got out of control and, well, they burned the entire building down. It's a pretty powerful, if accidental, metaphor for the dangers of mismanaging centralized financial records.
Yeah.
So these early systems we've looked at were decentralized, but then came the Renaissance, and with it, a massive shift. We're talking about the centralization revolution, a whole new model pioneered by the Medici Bank that would basically define finance for the next 500 years.
The
The
Templars.
Medici family completely changed the game with the letter of credit. Before them, if you wanted to move value, you had to move heavy, dangerous chests of gold. The Medici said, no, just deposit your gold with us here in Florence. We'll give you this piece of paper, and you can take that letter to our branch in London and withdraw the same amount of gold there. For the first time, they separated the transfer of value from the movement of physical stuff.
So the Medicis created paper gold.
Yeah.
Think about how much trouble that's gotten, a lot of people into. A lot of banks too, because if they can just, print paper gold or print paper silver, that could be part of the reason why we've gotten this massive squeeze higher.
Well, and it's not, crypto's not immune to it. A lot of people are talking about Bitcoin and paper Bitcoin, with ETFs and things like that.
Yeah. And man, tokenizing everything, do you think that will lead to more paper everything? I don't know.
And this created what we now call the hub and spoke model of finance. Suddenly, you didn't need to trust the person you were trading with anymore. You both just had to trust the central hub, the bank. The bank kept the main ledger for everyone and guaranteed all the transactions. It was incredibly efficient, but it also created a totally new kind of risk. And this was the crucial trade-off. This hub and spoke model made global commerce possible. It was a huge leap forward, but it also introduced a single point of failure. If that central hub, the bank, ever went down, the entire network could go down with it.
For centuries, this model actually worked remarkably well. But in the 20th and 21st centuries, that hidden fragility, that single point of failure, was about to be pushed to its absolute breaking point.
This breakdown didn't happen all at once. It happened in stages. First, in 1971, the US dollar was completely cut loose from gold. Money became pure fiat, valuable only because a government said it was. Then, in 2008, the central hubs themselves, the major global banks, failed on a catastrophic scale, kicking off a global financial crisis.
Yeah, so before 1971, the paper currency, which was kind of pioneered by the Medicis, right? They were the ones who, issued that paper gold at first, but it was always backed by gold, right? You could go and take that piece of paper and get physical gold.
Yeah.
Well, up until 1971, I guess you could take your dollars and get physical gold.
This is something I'm intimately familiar with, just running a gold and precious metal shop and collectible coins and things. So the notes, the bank notes, dollars, $20 bill, $100 bill, all that, they used to say on them that it was transferable for a silver certificate or a gold certificate. You could take in the cash to any bank, put it down, and they would give you an equal value of gold or silver. So pre-1971, that's why they talk about that the dollar was backed by gold. Now, they changed that. And as soon as they basically removed the dollar being backed by gold, all of a sudden, now it's backed by debt. And that's why we find ourselves in a lot of the issues that we're having right now, is that the government, there's nothing restraining them from printing more money. Whereas before, if they printed more money, it had to be backed or pegged 1-to-1, with the equal amount of gold. So if they printed a dollar, they had to, basically in Fort Knox, or they had to custody somewhere a dollar's worth of gold to back that dollar that was printed. That's where we started seeing a lot of problems. But go ahead.
Yeah, so think about the tokenomics of that fiat system. If the U.S. Treasury system were a DeFi protocol, it would be inflationary, the token would have an unlimited supply. It would not be backed by anything. So it seems to me like if the US Treasury system were a DeFi protocol, I wouldn't want to have anything to do with it, because you know that token is just going to continue to inflate away. And so how do you hold it? Well, that's the dollar. The dollar is that token.
Yeah.
And it's inflating away. So,
well, and if you know history, I mean, honestly, this is like you're going through right now is crypto is just the evolution of, something that represents value. It's and all it's doing is evolving, and it's now making, again, like with RWAs and things like that, illiquid things liquid, like gold. That's what the dollar was doing is, if you had $1 million worth of gold, that's a lot harder to move than $1 million worth of cash. A piece of real estate. You can have the ownership of the property and you possess it. But what if I want to, transfer that to somebody? That's why they came up with deeds and things like that. And now they're tokenizing it, so it's digitized, so it's even easier to move than it was before. This is all just kind of the same old thing, just the modern version of it. So,
yeah, Mike, I'm kind of worried about the regulation being written by lobbyists in Washington for the big banks. That Clarity Act being written by banksters, basically being written by their lobbyists, because all of the amazing innovations that I can't wait to be able to use in DeFi, like a tokenized deed to a piece of real estate, or a tokenized car title, or you name it. Like, I can think of so many cool things, like all of the different financial engineering things that you can do with tokenized real estate, tokenized assets.
Oh, fractional ownership. You could buy an Airbnb, tokenize it, let people invest in that to where you have that liquidity back. You still own it, with those people,
right?
Where they're going to earn dividends from it getting rented out, and then you can take that liquidity, go buy another Airbnb.
So all of those ideas, Mike, those are such good ideas. Like the financial engineering that we could do if those products were available. Dude, it's just the sky's the limit. But here's the problem. If we can do that stuff, then that means the big banks who control all of those markets and create friction. That's all they do. Like, that's the business model. The business model is create as much friction as possible so that you can charge as many fees as possible. That's the model.
That's how they make their money, is they profit off of friction.
Exactly. And so, but I'm just concerned that if we get poor quality legislation out of Washington because it's written by the banks, then all of those cool products that I can't wait to use will just be made illegal, or they'll be made to be controlled by the banks themselves on some private walled garden chain. So it's like, man, where are we going to get like true freedom? Where will we be able to use these new and amazing products? Where will they be legal? And I really, really hope that, we get legislation in the United States that spurs that type of financial innovation and does not just hand over the keys to these large banking institutions.
That's what's being fought right now in Washington with the Clarity Act, and Coinbase is, fighting, and, a bunch of other people are fighting because, the banks, Elizabeth Warren, one of the heads of the finance committee, she was, fighting crypto forever, under Biden.
She's like the queen of the Karens, man.
Oh, really absolutely. Absolutely.
Did you see the video of that one lady? Like, some dude is out like fishing somewhere, and this lady just like comes out of the bushes. Okay.
Oh yeah, I saw that. There's a couple of guys. They're duck hunting. And it comes out screaming at him, and like, what are you doing?
Sounded like a bird, man. Yeah. I thought it was before she came into view of the camera.
They had all their decoys in the water, their duck decoys, and she was throwing rocks at them, trying to scare them away to save them from the hunters. And the guys are laughing, like, they're decoys.
I thought it was a bird. I thought that because just listening to her, it
Yeah,
sounds like a bird. And that's kind of what Elizabeth Warren reminds me of. She reminds me of like, just a screeching bird that like doesn't make any sense. And she's paid off, man.
Oh,
You
by
know?
the banks, yeah, 100%.
Yeah,
And she has no integrity. I mean,
I
even
don't
before
think
she got
so.
into office, she proved that,
Oh, yeah.
claiming she was Native
She's
American,
Native American so that
well,
she
so
could
she
get
could
into
get hired
Harvard.
professor as like a DEI hire, basically, at Harvard. And yeah, she's bought and paid for.
Yeah.
That's obvious.
It's just such a shame, man, that there are people who put up this front and you look behind the veil and the emperor has no clothes, man.
Yeah.
So let's continue playing this. This is pretty interesting content.
And the consequence of these hubs failing was just staggering. The entire system froze. To stop a complete meltdown, governments had to step in and inject over $1 trillion of public money.
So what the video content is talking about here is the failure points. So what happens when a centralized system starts to fail? And so the best example of this was 2008, when banks refused to lend to one another. And so what had to happen? Well, you could actually make an argument that this didn't have to happen, but what ended up happening was the Fed and the US taxpayer provided a shit ton, I think that's the right word, shit ton of liquidity to these banks so they would start lending again. So when a centralized system starts to fail, the entire system can come crumbling down. And hey, the bailouts that we saw in 2008 and 2009, I mean, it stopped the system from blowing up, but it also started us on the path that we find ourselves on today, where we've got $40 trillion in national debt. So,
Yeah.
To patch the holes in the private ledgers of these huge banks.
That whole crisis exposed this deep, bizarre contradiction at the very heart of modern finance, something we can call the trust paradox. We were all forced to bail out and then continue to trust the very institutions that had just proven themselves untrustworthy,
right.
simply because they were too big to fail.
And so why in the world would we ever want to hand over the keys to DeFi, this new engine for financial innovation, to the same institutions that have proven that they are not trustworthy? There's no way. So I really hope that that legislation in Washington gets rewritten.
Letting them collapse would have taken the whole world economy down with them.
Now, it's definitely not a coincidence that right in the middle of all this chaos, in October 2008, an anonymous paper quietly appeared online. It proposed a brand new system of money, one that, funnily enough, looked a whole lot like those old systems from the very distant past.
You see, Bitcoin wasn't just some new digital coin. It was this brilliant synthesis of thousands of years of ledger technology. Just like the Rye Stones, its ledger is secured by public consensus in a decentralized network. And just like the tally sticks, its records are made tamper-proof. But instead of using wood grain, it uses powerful cryptography. It was a return to that decentralized model of trust. And this right here represents a fundamental shift. For 500 years, our financial system has been built on what you'd call institutional trust, trusting people, brand names, government regulators. Blockchain proposes a new model, programmatic trust.
And no one trusts institutions anymore because they have proven themselves to be untrustworthy. I mean, all you had to do was be alive during COVID to know, hey, what people are saying, what these institutions are saying, and what I see on the ground, these are two different things. I'm being lied to. So when you see that these institutions are just not trustworthy, what's the alternative? Well, I think code is law is the alternative. Programmatic trust.
Yeah.
Instead of trusting people in boardrooms, you trust open source code and verifiable math that anyone in the world can check for themselves.
Right.
So after this whole journey from ancient islands to the modern financial crisis, we finally arrive at the future of trust. So what's the big takeaway? Why does any of this history matter to you?
Well, the key takeaways are pretty simple, but they're also profound. First, just remember that money isn't really a thing. It's a ledger technology. Second, centralization, the model that built our modern world, is super efficient, but it's also incredibly fragile. Third, blockchain isn't some brand new idea out of nowhere. It's a clever combination of ancient principles and modern tech.
That's
And
so
finally,
cool.
the big shift we're living through right now is this move away from institutional trust and towards programmatic trust.
This history gives us the context we need to understand why technologies like blockchain even exist. And it leaves us with one last really big question to chew on. If we can now program the rules of trust directly into our money, getting rid of the fallible middleman, what else can we program?
Well, the sky's the limit. What do you think about that, Mike? That was a lot of fun, man. Going
No,
through.
it's, I mean, but it's kind of a core principle of crypto and DeFi is and that's kind of why we're here with this kind of entry level DeFi, is to give people a deeper understanding of what they're investing in. Because yeah, I mean, you can just invest in whatever the hot narrative is, or you can invest in whatever you're seeing on a social media post, where they're claiming it's going to 100x, 1000x, or whatever. I mean, that's one way you can do it. But honestly, I prefer to be a little more calculated. I prefer to be, and not to say I'm always going to get it right. It's Casper was one that I invested in that I've kind of I don't think it's dead, but it's definitely really quiet right now. Plume is another one that we've gone over that has lost a lot of its TVL. As far as RWAs, it's still growing. The amount of RWAs that are being tokenized on it, but there's nothing to say that TVL is going to come back. But you're going to have a much better chance of picking the winners. All you got to do is out of your investments, if you're investing in about 8 or 10 different projects, you just need 2 or 3 of those to be one of the ones that ends up being where institutions are storing their value, that they're using it to move value. The Google, the Amazon of DeFi and the RWAs in the future. If you can just get in early on one of those, even if the others go to zero, you're going to profit. So that's the game right now, is figuring out this new system of of DeFi and investing, so that you can be the bank, so that amongst us, that we can collect the fees when we're borrowing and lending to each other, and we can earn, because traditionally they had a monopoly, and that's why they're panicking. You can look at the news right now. You have banks that are in full panic mode. That's why they were using Elizabeth.
That's why that legislation looks like such bullshit. Because
It's
they're freaking out, man. Because all of these new financial products that you can engineer on DeFi chains, on public chains, these products are so much better. Like, why would I ever go to a bank if I can just tokenize the title to my car and borrow against it? Why would I ever go to a bank if I can tokenize the deed to my house and borrow against it? All of a sudden, that entire industry of home equity lines of credit and those revenue streams that the banks rely on for that, that just goes away. Because, hey, all they do is introduce friction and fees. And then you got to deal with some loan officer who probably doesn't want to approve your loan anyway for reasons that maybe have nothing to do with your creditworthiness. So you don't get the money that you need to grow your business because some loan officer, they're having a bad day.
They don't like how you look, or
they don't like how you look, whatever it is. But if you're using DeFi, then guess what? Code is law. So all that matters is, do you have the collateral or not? Yes or no? If yes, then you can borrow to this LTV.
A democratized, financial system, where, like David's talking about, you own your house. It's tokenized on chain. Yeah, you can go to a DeFi protocol. You can put it put it in there as collateral, potentially maybe even earn some kind of yield on it and take out a loan against it.
Imagine that. So if you can tokenize the deed to your house, Mike, and so instead of, you could actually like build a reverse mortgage, not like actually a reverse mortgage like the traditional reverse mortgage.
No.
But if you own your property, then you could put that up and potentially earn some type of yield on it. And then you could even borrow against it. And if you're earning more on the deed to your house than what you're paying to borrow, then you basically
positive, you have
create
income.
interest rate arbitrage.
Yeah.
Yeah. So those type of
and those that don't know, reverse mortgages are became a thing because a lot of older people were having problems with having enough money to live, to survive. And so basically they created something called a reverse mortgage, and I won't get into the details this episode, but basically it was a way for people, elderly people, to access the liquidity of their home to pay for medical expenses, food, gas, utilities, property taxes, whatever. And then, of course, the person that gave you the loan has a lien basically on the property. So, after you're passing, then it gets sold, they get paid back, and whatever's left goes to your heirs, that kind of thing. So,
yeah, but you could structure that in DeFi.
To be much more advantageous.
But you actually, the loan pays itself off over time.
Yeah.
So as long as you've got a positive interest rate arbitrage, then that loan actually pays itself off.
It could be part of a trust. You could do that as part of a trust.
All of those products that don't exist quite yet, but if we get the right legislation, could exist basically overnight. That is what is so exciting about DeFi right now. So I think we're out of time, Mike, aren't we?
We are. I appreciate it. I love talking about this stuff.
It's so fun.
If you want to join us tonight, David, we're going to be having our Thursday night show called The Red Pill, and it's where we get extremely based. We just have people pop in and out. They don't stay the whole hour sometimes. Colin's going to be joining us tonight. Of course, me, Jeff, and I'll be throwing Malik an invite, throwing David an invite, and some, my brother Taylor, some other people. And it's just where we all, kind of sit back and we talk about whatever comes up, whatever the macro news is. If we want to talk about conspiracies, if we want to, talk about the new world order, whatever, we talk about whatever. So it's a lot of fun. If you want to join us, that goes down 6 p.m. Pacific, 9 p.m. Eastern time.
I'll see you then. Well, so 6 p.m. Pacific.
It'd be 9 p.m. your time.
Yeah, let me just check my calendar. I can definitely make it. I don't know if I'll have. I'll just throw it on there. I'll see you at 9.
All right, sounds good, and hope to see you all there. Until tomorrow, Veteran Crypto out.
Peace.